are watching Benzinga Live.
Welcome back to another episode.
I think Tesla could be vulnerable to that.
Layoffs happened today on Google, and the market's on.
In terms of breaking.
Amazon, Salesforce, Apple.
All right, what's up, Zinger Nation? Welcome back to another episode of Benzinga Live. What up, Rodrigo in the chat? Shout out, Rodrigo. Let's go ahead and check out EBS since that's what he's been asking for. Let's go ahead and pull up my Benzinga Pro real quick. Okay, my keyboard's lagging right now, so instead of looking at EBS, let's take a look at Apple first, since Apple reports earnings tonight, and this will be the big market mover after the close. We do have some more. We have labor data coming in tomorrow morning. So whatever Apple's move is tonight will most likely be impacted by the labor data tomorrow. Like if Apple's up, say, 5% after the report, and then we get hot labor data and the market's selling off, it wouldn't surprise me to see Apple come back in. But regardless, let's take a look at the chart first, then we'll get into the fundamentals of Apple as we head into the earnings report. So chart-wise, we've been in this downtrend. Apple hit above, right around $200 a share back in December. At the time, Apple was a $3 trillion company. And we've been selling off since then. And there's been a number of different headlines and reasons for that. Basically, the Vision Pro that has come out has been, I think, a little bit underwhelming, both for consumers and for investors. We're used to Apple coming in and just destroying it with new products, demand being off the charts. Even if you go back to some of their smaller products, right? AirPods at a point were like sold off and sold out, and there was not enough supply to keep up with the demand for AirPods. Apple Watch, kind of same thing, right? People didn't think it'd be that big of a driver. Apple started, bringing in billions of extra revenue off AirPods and Apple Watches. Now, this cycle, the iPhone demand has been a little bit weaker, especially in markets like China. The new iPhones, people aren't, haven't really been, I don't think, killing it. And a bunch of analysts that I've been reading are saying that, look, the next iPhone cycle is expected to be stronger, this and that. So it wouldn't shock me to see Apple, which Apple usually crushes it on earnings. It wouldn't shock me to see Apple actually have somewhat of a lighter earnings report than it's used to. But the thing is, and this is what we've been talking about all the past 2 weeks in this earnings season, is it's all been about the bar set coming in and the expectations. So now that the expectations have been lowered a little bit for Apple, and I don't think it's, we're looking at Apple as they have to crush it and beat on both and raise guidance. Like some of the, if you go to some of the chip stocks, right? SMCI reported some pretty decent earnings. The stock sold off big time because those expectations were so high heading into it. And especially in anything that's been involved in this AI, I'm not going to call it a bubble because I don't think, I don't think NVIDIA really, overextended, maybe a little bit, sure. But I'm not going to call it a bubble because NVIDIA, unlike other bubbles we've seen in recent years, whether you're talking, some of the metaverse stocks that ran in 2021, or you're talking GameStop and AMC, the difference between NVIDIA, SMCI is there's fundamental growth to back it up. The companies are selling more. There's more demand for the company's products based on this AI boom. So again, overextended, sure, maybe. I don't even know if NVIDIA is, but SMCI sure was and pulled back, but I'm not ready to call it a complete bubble. And then, Apple on the flip side has not been, into that group, even though the company's been saying it's working on some AI products. It announced its new MacBooks coming out at the end of this year will, they'll implement some AI features in it. They're working on their new chips, but Apple, it's been the opposite of NVIDIA, of some of these other tech stocks, where it's really been lagging the overall market this year. And so again, the bar is set a little bit lower coming into Apple's report. Someone in the chat was asking about Apple puts. I wouldn't be buying Apple puts on this report just because, again, I think you look at this move that the stock has made from the end of January to now, we're in the beginning of May. So what is that? A 3-month move from 200 to 170. Like that's a significant retracement for Apple. And I think a lot of this price action on the downside has been pricing in a weaker earnings report than we're typically used to seeing from Apple. But again, like I think a lot of the weakness in Apple right now, whether it's from the iPhone demand being smaller than normal, it's cyclical, right? I don't think like Apple has like big structural problem, that from here on out, Apple is going to have declining quarter over quarter revenue growth. No, I don't think that's the case for Apple. I don't think, China iPhone demand being a little bit weaker the past 3 months is like going to be the nail in the coffin for Apple. And we're going to see it come all the way back down to, 124, where we saw it when we got the big crash at the end of 2022. So, as far as Apple options going in here, do I think there's a potential that because the bar is set lower, Apple actually reports a good quarter and the stock takes off? Yeah, I do think that's possible, but those would be like looking at like lotto calls. And let me pull up my options chain just to see what some of those would look like right now. And then I'll get into some of the other option plays that I actually am getting into today. So Apple, let's see, if you wanted to buy, and here's actually the good thing is if you wanted to wait till like Thursday, this afternoon and buy Apple calls, they expire tomorrow. So you're not spending a lot in terms of, there's extra volatility because the company is reporting earnings, but you're not spending a lot in terms of the time decay. So for theta or anything like that. So, and again, you do have those labor numbers coming in tomorrow morning. So whatever you're playing options wise tonight, just know that before the market opens tomorrow, we will get labor data that will impact the market either to the upside or the downside, almost certainly. Yeah, see, these are still pretty expensive. Well, I mean, like if you wanted to buy, let's see, we're trading at 171 right now. Let's see what the expected move is. Apple. So it looks like the expected move is about, wow, it's only about like 4% for Apple. So for 170, what would that be? That would be about like $9. So basically like your 180s would be the calls to the upside that would put you right on the expected move. To break even, you would need it to go up about 5.2%. And those are 75 cents right now. I'm trading higher today because Apple's up about 1.5%. I think, I think there'd be more upside right now just because, again, that bar has been lowered a little bit to playing the calls like that. Like I might, look at like even some like 180. What if they crush it? Because those are actually pretty cheap and you can just sprinkle. But those are like lotto plays, not an investment. Basically just a bet. And then as far as like other option strategies, I don't think selling, if you wanted to own Apple long term, I don't think selling some sort of put or put spread would be like the craziest thing in the world because I think there's a lot of interest in the puts right now. But again, like I just like to me, I think Apple would have to miss significantly, which the company doesn't really have a strong track record of doing, missing earnings, for it to trade off another 5%. Because it'd be one thing if Apple was at all-time highs going into this report. And I know I kind of sound like a broken record right now, basically saying it's all about the expectations into the report. But Apple is already like, it feels like we're at this kind of price discovery, this floor right now where Apple's not really going to go much lower than it is right now. And I could be wrong and Apple could miss a huge, miss big and the stock drops another 10% and goes down to 150. But if that happens, we're in some trouble anyway. It's like, I just don't think to me, again, Apple has, if you wanted to go short Apple, the time to do it was, 15% ago, not now when we're already drawn down here. I mean, if you look, and we'll go to the fundamentals real quick here on our Benzinga Pro. And this is why I really like Benzinga Pro. Like, we can look at the charts right here and then just boom, super easily look right over here to the right side at the fundamentals. Forward PE of 26. Okay. I mean, like not the cheapest in the world, but not the most expensive. I mean, nothing compared to like a Tesla multiple or anything like that. Price to sales below 7. So again, kind of similar, not like the cheapest stock in the world, but also not the most expensive. The company also does pay a small dividend now. So, I mean, I don't know. I wouldn't be shocked if Apple announces some sort of like, buyback or something like that. And the stock trading higher this morning. What was the news? Oh, we had some AI news this morning, actually. It was from Wall Street Journal. So there's the Apple preview. I'd be more open to playing it on the long side through some kind of lotto calls I would be basically just looking at as a bet. Again, the 182.5s are 45 cents right now. So I might pick up like 3 of those for $140 and just $135 and just call it a day. And then if Apple like crushes it and the stock's trading higher in the 180s tomorrow, I'd make a pretty penny. And if not, okay, I had a defined risk. I was okay risking that much money in the market and would be okay with losing it all, because if you're trading on these binary events like earnings reports through options, you basically have to be okay losing like the entire premium you're putting down, unless you're doing some types of different spreads, strangles, straddles, etc. Yeah, Jay, we're moving from Apple. We're gonna go into Coinbase now, which also reports this afternoon. Coinbase, if I can get, I don't know why this my keyboard's like I think it's running out of battery. Oh, there we go. Coinbase. So Coinbase, I think, is kind of the opposite of Apple, to where you have you have raised expectations coming in just because crypto was so hot through the first 3 months of the year. And that's what this earnings report will be looking at, is Q1. And like, actually from a stock perspective, like with that said, and a lot of this is probably priced in, and I mean, Coinbase is up 5.5% today coming into the report. But because of Bitcoin's recent weakness, starting a couple weeks ago, starting really like into and after the halving, I mean, the halving event like hasn't been as bullish as I think a lot of people expected for Bitcoin. And now that Bitcoin has retreated a lot, and thus Coinbase has come down a lot, you actually have a better setup going into the earnings report. And the earnings report shouldn't really reflect all of the first 3 months of the year. So like, it wouldn't shock me if Coinbase crushes it in terms of EPS and revenue in those 3 months. But then maybe their guidance is a little bit lighter, because they're saying, hey, we're actually seeing outflows of the Bitcoin ETFs. We're actually seeing less trading volume the last month or so. So the market is always forward looking. So again, just because Coinbase reports really strong numbers for the first 3 months of this year, which I fully expect the company to do, it does not mean that necessarily the stock will be trading higher, because if the company issues weaker guidance or says anything along the lines of, oh yeah, trading volume the last month or so has actually been lighter, I don't know what they're going to say, but it wouldn't shock me, I guess, at the end of the day, if the company has some sort of way of kind of dampening expectations for the next quarter, just because I don't think Coinbase knows where Bitcoin is going. So if Bitcoin doesn't go back up above, 65,000 and get all this excitement back, and you have people trading Dogecoin and ETH and like all these other altcoins again, not again, but like, the hype cycle seems to have run out just a tiny bit. And I think it's hard for Coinbase to predict if Bitcoin and these other cryptos are going to start rallying again to get more trading volume. You're always going to have your base amount of hodlers, of people that trade crypto, all of this. What Coinbase needs and what Robinhood needs, and I see, Jay's Life asking about Hood as well. What those companies need is like not the crypto people trading, the average person, the average American being like, oh shit, Bitcoin's at 70K. I got to buy some. And then they go in. And that's when you see more and more people rushing in to buy, is when the prices are near and at all-time highs. So to have Bitcoin hovering around 50,000, I don't even know where we're at, I haven't checked in a little bit, is not, great growth numbers for, okay, so we're back at 60,000. So, again, the good news is Coinbase's stock is well off its highs because of Bitcoin's recent action. The bad news is this recent action also probably means less trading volume for Coinbase. Good news, that won't really be reflected in this report because you're looking at the first 3 months. So all in all, I think the numbers will be strong enough in the first quarter to give Coinbase's stock a bump. And then, if depending on what the company says, it will really matter. And like, I don't know, I assume Brian Armstrong will be speaking on the earnings call and basically, I don't know. I mean, because some CEOs, like, more your Elon Musks, like to focus on the positives and make everything sound really, really good. Other CEOs in the calls a lot of times like to kind of, like I said, like lower the bar for expectations, dampen what investors are looking for going forward by saying like, yeah, like last quarter was great. But, this quarter we haven't been off to that hot of a start, and we don't know where Bitcoin's go, so it's like, to me, the numbers for last quarter aren't really what I'd be looking at here for Coinbase. We do have a special guest today. We've got Bill Capuzzi from Apex Fintech Solutions going to be joining us here momentarily. Let's go ahead and, okay, I see Bill's got his camera on now. Let's go ahead and bring Bill on. We're going to be talking about some retail trading themes, some different types of access that people are getting now, what it means for the market. So it should be a very good conversation. Feel free to drop questions in the chat. And let's go ahead and give Bill our very, very special Zinger Nation welcome. All right, Bill Capuzzi, welcome back to Benzinga Live. How you doing today?
Good to see you again. How's things?
Things are well. I mean, I feel like it's a much different trading environment than maybe the last time that we spoke. What have you got? I guess before we get into like the specific trends and what we're seeing in the markets, like can you, for our audience that aren't familiar, talk about Apex and what you do there?
Yeah, sure. I think probably the best way to describe Apex is sort of maybe for the older generation on this is the intel inside for investing. Right? So think of Apex as sort of this platform that really powers most of the firms that are out there offering a sort of direct-to-consumer investing solution. Right? A lot of the firms that you guys talk about on the show. So SoFi, Stash, Tasty, Webull. All of this sort of next generation of investing uses Apex, right? And it sort of manifests itself in, we support roughly 21 million end investors, many of which are probably on this and listening to this. Roughly 53% of those 21 million folks are millennials. Another 18% are Gen Z. So it's definitely skews to a much younger cohort of investor. And that's probably makes a lot of sense because we have, close to 70% market share in terms of supporting these, sort of disruptors that are offering solutions to end investors.
So, I mean, Bill, right now, right, like the kind of euphoric type of markets that we saw during COVID and after COVID in 2021 have normalized somewhat. There's still a lot of craziness in the markets, as I'm sure I don't need to tell you. But what are you seeing overall? How has the average retail investor, and I love that, you guys focus on a younger audience, so do we.
Yeah.
How has like the younger, say average 30, 35-year-old, retail investor, how has behavior shifted since 2020?
Yeah, so let's get into 21, then into this kind of lull in 22 into 23, and then where things are today. So everything was up and to the right. Lots of money flowing into the system. The government was trying to get us out of the position as it relates to the pandemic. No sports, and people were. And by the way, there's amazing access to the markets, right? In between, I just got off, just listening to you talk about Coinbase, right? Both the equity markets, the options markets, and the crypto markets were rocking and rolling, in 2021. And I'm proud of the fact that, as Apex as this kind of intel inside is, okay, we allowed people to access the markets with, a fraction of what it was, 10 years ago. In terms of, okay, you can log on really quickly, you can open an account, and you can start investing with $100 in an account. Like that's pretty cool versus what it was, 5-10 years ago. And everyone was, thought they were, a professional day trader, right? Because everything was up and to the right. Everything was you couldn't lose picking stocks in 21. And then we kind of hit this wall in 22, right? Where there was a little bit of a flush of the market where people, realized that, hey, things that do go up oftentimes come back down. And so what we saw was a lull, right? People moved to cash. The activity, the trading activity in all asset classes, especially in crypto, really kind of fell pretty significantly versus the highs in 21. But what we started to see was, and it's somewhat of what Apex is doing, is a climb back in 23, different than what we saw, in past sort of gyrations in the market. The first big thing that happened is people started investing in fixed income, really for the first time. I think this cohort you're talking about, folks under the age of 40, the first time people started to invest in fixed income. And why, right? What was the driver? If you think back to 22 and to 23 and now, into 24, yield, right? For the first time, fixed income was actually generating pretty good yield for folks. And then the second part, which I think ties directly into what we do as a firm, is access. I mean, I'll ask you, have you ever bought a corporate bond?
No, I have not.
And my bet is most of the people that are listening and watching this haven't either. And it's a asset class, number one, for rich people, and two, the yields weren't there. Well, the yields are there; they're better than they were, and the fact that you can now buy a fractional bond through a platform like Apex, pretty meaningful, right? So I say it's for rich people. Is many corporate bonds have a minimum of $10,000 ante to buy a bond, right? So who could buy, who's going to plunk down $10,000 to buy a corporate bond? Now you can buy it with $100. You can buy a fraction of a bond, and that's never been available, to the the retail public before.
Yeah, and that's it's so. Sorry, go ahead.
No, I was just saying that fixed income. We can talk about options because options volume is way up. But for the first time, and give you some perspective, fixed income trading has grown 25x at Apex over the last 3 years, and then the number of accounts that are actually have now a fixed income position over the course of the last year has increased about 169%. So massive amount of people now that are now rightfully adding some fixed income exposure to their portfolios.
Yeah, it's so interesting seeing, I guess, in real time, like this group of investors and traders grow up and go from, the up and to the right, buy everything type of market to, okay, now that's not working anymore. Let me just passively invest in these ETFs and let me go buy these, fixed income products and these T-bills and, the corporate bonds and all this. So I think what I think a lot of people have been surprised by is that, I think a lot of people assumed that after the euphoria was taken out of the market after 2020 and 2021, that you would just see a complete dissipation of this whole cohort of investors. But instead, they've kind of just shifted strategies and started, investing in different ways, and frankly, in ways that are probably a lot more wise. But you mentioned that options trading specifically has still remained high. Like, do you think, because those don't really go hand in hand. Like in my head, I think, okay, people are now investing more in fixed income and in ETFs and stuff, so they're probably trading less options. But you're saying that's not what we're seeing?
Well, I think there's two parts. So I think to your point, people saw for the first time some pain in terms of give back in the markets in 22, and shifted part of their portfolio to cash, right, and then part of the portfolio to more passive investments. And what didn't happen, to your point, is people didn't pull their money and go find an advisor and say, oh my God, I'm terrible at this. I need to give my money to somebody else. And they just found different ways to start generating returns for their portfolio, partly in cash, right? So they're making 5% on the cash, partly in the fixed income part. And then thirdly, is finding these passive investment vehicles, right? So like you said, bond funds, ETF funds, versus taking a bet on a certain stock. What I would tell you though is, and I think it's healthy, is especially in the younger cohort, is you have the ability to take more risk, right? Because you have a longer time horizon. And the fact that we've lowered the barriers for people to access things like options It allows them to express their views in the market. And so, what I think we see is less activity concentrated in options, just many more people now using options
Got
as
it.
part of the portfolio, right? There was a lot of concentration in 21 where people were using it to sort of juice the returns on their portfolio, but it was fairly concentrated. Now what we see is more activity across just a wider group of people, in part because access is a ton better than it was. Folks like Benzinga doing amazing things to teach people how to use options. And then secondly, like I said, the access is there, right? That wasn't there. Right? Options, and to the lesser extent futures, was an asset class that largely was institutional or was a professional trader. And now there's people that are using it and expressing their views. It's just a much wider audience than it was 2, 5, 10 years ago.
Yeah, and that makes sense that I guess in 2021 and in 2020, you may have seen more accounts where 80+% of the trades were options trades, whereas now maybe it's less concentrated in those portfolios, but you have more total portfolios to make up for the people that are maybe trading a little bit less options. But going back to the access, and I think right now, I mean, we're in this time where it just seems like there's just more and more access coming every day. I mean, we went from, okay, now we can trade, 0-day options,
Yep.
On SPY and Qs every single day. We can do more weekly options. And then it was, okay, now Robinhood's offering 24-hour trading. What are the benefits? And then if you don't mind, I mean, I know this is kind of your stuff, but I'm sure there are at least a few potential downsides to giving all of this access, unless your answer is no, there are no downsides. It's all beneficial.
Yeah, look, so you mentioned 0-day options. It's interesting to see how quickly this is sort of gotten sort of legs, and it's intraday, making a bet intraday, which obviously isn't akin to a long-term investment. It is interesting to see how much interest there has been, and it is you hear it said it's tantamount to gambling. Like you're intraday taking a position. I think it's more kind of akin to a retail professional type trader than it is for John Q. Public. I would say there is a sort of strong corollary to sort of online betting that is taken off for this younger cohort. Right. So you have this, DraftKings online, you can bet on anything. 0-day options has a similar feel, at least from my perspective, for certain cohorts of investors, right? So the casual investor, the 24/5 thing, we launched around the same time as Robinhood. I'm a strong proponent of this. And I'll tell you why. So I sit on the board of DTCC, which is kind of the industry utility to settle trades. And, the cool part is inside of, less than a month, we will go down to settlement date of T+1, which is awesome. Like we're taking one more day out of the system, right, to settle an equity trade, which is amazing. But we still settle trades. It still takes 24 hours to settle a trade. So there's still a lot of nonsense in our industry, right? And when you think about, accessing liquidity, and price formation, right? Let's talk, you mentioned Coinbase, a stock before. You're out to dinner and you're talking about Bitcoin, you're talking about getting exposure to crypto. Why can't you buy, a fractional share, $250 worth of Coinbase at 8:00 at night, right? You're sitting in a out to dinner here in New York City. Why couldn't you do that? And so, I think that this is where we're heading. And the fact that we can't do that today, I think is not in the best interest of, especially retail cohort, which is you want to express your views when you want to express your views. And then the second part I'll tell you about, 24/5 is it's a global world, right? There, access to the U.S. market,
Right.
which is the most amazing market on the planet. People want to access this market from outside, right? They don't want to access their local market because there's no liquidity. There's nothing to invest in. But they do want to invest in the U.S. And what we're finding, right, again, is this Intel Inside is Apex, is there's a lot of interest in accessing the U.S. markets, but not 9:30 to 4 p.m. Eastern, right? So as a good example, South Korea, there's quite a few people there that have interest and want to trade during their day. And that's happening today. And it's happening a lot more than I think people know that it is. The biggest challenge with this really getting going is that, most of the market is driven by institutional players, right? Big hedge funds, big buy side, and then the corresponding brokerage firms, Goldman Sachs, Morgan Stanley, Merrill. They want to come in, do their thing like they have done for the last 20 years, and they want to leave at 4:30, right? And so, a big, I think, impediment is that we have this machine that has sort of been built over decades, and breaking through that and forcing those people to think that there is actually price discovery and liquidity outside of the normal hours, I think it's just going to take some time.
Yeah, that all makes a lot of sense. And I think, I always, I'll tell my friends and stuff that are trying to get into investing and whatnot, you're probably better off just buying the S&P 500 every 2 weeks or so than trading 0-day options, especially if you're a beginner or whatever. But isn't it nice to still have that option to do that? No pun intended, to be able to trade outside market hours. That's how I view the whole access thing is could it be detrimental to someone who might be, newer and doing it too much? Sure. But isn't it better to still have the opportunity to do that rather than be blocked off for it and have it only available to institutions? So I think it just comes down to, which it's no different than buying regular common stock, coming down to doing it responsibly. So, you could always go out and buy any common stock during market hours. So, if someone was going to go throw their whole entire life savings into some pre-revenue energy company, that's probably not the smartest thing to do. Just throwing all your money into a 0-day options expiration is probably not the smartest thing to do. But I'd still rather be allowed to do it versus it being blocked off from me. Bill, I got to
think about just, I just say, just people have passions, and you should be able to express those passions, right? So you take your long-term money, you put it into the S&P, you put it into ETFs, into a passive portfolio, but then you want to express your passions, things that you believe in different ways, right? Whether it's 0-day options, whether it's individual stocks, maybe it's a future on a particular name. There are ways to do that, and I think the cool part is that access continues to get better at prices, in terms of the cost to entry, continues to come down because of firms like Apex, which is, pretty cool.
Yeah, well, this has been an awesome discussion, Bill. Just learning more about, what retail investors are doing, the trends, and the access that we're getting right now. It's always good to catch up with you. So we'll have to have you on in a couple months or so to catch up.
Yeah.
Do you have any hot takes when it comes to the market? Do you think we're going to see some behaviors get, crazy? You think, we're going to see a big market crash, anything like that?
The one part I would say is that, I think this IPO market continues to heat up. And I think there's a huge backlog, and I think we're going to see this logjam start to unpack. And we're seeing signs of that already, but I tell you that, and I think there's some really quality companies that are going to come out via, the public markets. And I think like I said, I know for a fact, just talking to the investment bankers, there is a very large, logjam of firms coming out, waiting for the right times. And my expectation is we're already seeing sort of the tip of the spear, but my expectation is we'll see a heck of a lot more of it, coming into, going into the election. I think the election will pause things because people are going to be nervous about, going public around that time. But the next 12, 18 months, I think we'll see a big sort of surge of IPO activity.
Yeah, I saw it, of course, with Reddit. I mean, we had a whole 2-year lull where once the market turned over in 2022, like no one went public, but all these companies still exist. So they got to be waiting somewhere. So we're going to start to see more of those come in. But Bill, I enjoy the rest of your Thursday. Thanks again for hopping on Benzinga Live with us.
All good. Good to see you. We'll talk soon.
Yes, sir. All right, guys, that was Bill Capuzzi again from Apex Fintech Solutions. Always good to catch up with Bill about what the retail investor is doing. And Apex is doing some really cool stuff, powering a lot of that trading access and stuff that we see on the back end, depending on where you are and what brokerage or firm you're using. Let's go ahead and pull my Benzinga Pro up real quick, just because I think we had a couple more. I don't think we haven't talked Carvana yet today, and that's like been the big. I mean, I know. Look, I know what you guys want. You guys want to talk the meme stocks, the crazy runners, and Carvana is definitely one of those. Up 35% today. I mean, look at this chart. Just a beautiful rounding bottom pattern. Coming back up here. Looks like we got some resistance potentially at 150, so that'd be the level I'm watching. But I don't know if we're getting back to 400 anytime soon on Carvana, but damn, this has been a nice move coming from about $3-4 back in December 2022. All the way back up above $100 now, up more than 2,000% from those lows. What a move from Carvana. I ran over. I was supposed to end the stream at 11:30, so I got to call it here today, folks. But my big play of the day, I'm buying DraftKings out of the money calls today. And again, this is kind of ironic because I'm taking a gamble on a gambling stock, but it is 100%. That's what it is. It is a gamble. I'm going to put like $300 into some calls on DraftKings. I'll either make a lot of money on them or I will have $0 from that 300, but I am more than okay losing that $300 on this trade. My thesis is basically like we talked about Penn earnings on pre-market prep. DraftKings is far and away, I'm not going to say the leader in the space because them and FanDuel really are the top two dogs, but they are far and away better than all these other online gambling apps like Penn's ESPN Bet or MGM's Bet MGM. So again, like I don't think Penn's earnings are going to be indicative of what we're going to see from DraftKings. So I'm taking a stab at DraftKings, buying some. I think I'm going to do like the $49 calls, so it would have to go up essentially like 20%. But DraftKings isn't a huge company, so when you see if DraftKings reports a very strong quarter, it's a $20 billion company, has a lot more potential. Like you look at Snapchat's moves. Snapchat is a similarly sized company at around $20 billion. You'll see Snapchat moving 20, 30% after earnings. You don't typically see that from an Apple or from a Microsoft or Amazon. You'll see like 5 to 10% moves, but not 20. So I'm good buying some out of the money DraftKings calls. Again, think about the first 3 months of the year. You have the Super Bowl. You got some March Madness in there. I mean, like, come on now. People were betting. And if I know one thing, it's that people were betting. And like Bill was talking about too, it's like the same type of audience that's trading options and betting on sports. Like for whatever reason, people like to take some speculation right now. People are willing to take on the risk. And I think part of it is social media stuff that people, what, 80, are you sorry? I think the like seeing the stuff on social media, like, oh, I just hit this $100,000 parlay, makes it feel a lot more achievable. You got to remember a lot of that stuff. I'm not going to call it fake, but a lot of it stuff's like cherry picked. Like you'll see like betting apps be like, oh, look at this slip someone hit. And it's like, all right, well, show me the 100,000 slips that didn't hit. So I'm not a proponent of the industry. I don't think long-term I'd be buying DraftKings just because I think there'll be a reckoning at some point of like, look at how many young men got their lives destroyed because they were gambling too much, and we'll start to see more regulation come back in. But I think as like a short-term trade, I mean, I think this is setting up beautifully into this. I wouldn't be surprised. It wouldn't shock me if we see DraftKings trading at all-time highs tomorrow. It really wouldn't. Well, actually, that'd be like 100% from here. Okay, maybe that would shock me a little bit. It wouldn't shock me to see DraftKings back up at this level tomorrow, $65, which would still be a huge move. Like 50%, but it just wouldn't shock me that much. All right, y'all. Do 450, not 300. What do you mean? Oh, put 4. Yeah, I mean, trust me. I mean, it's something that I've done now for like 3-4 years, and whether it be on sports or whether it be during Robinhood with options, like I know I am drawn to it, and I've like, I've figured out what I need to do it responsibly. And what I do is essentially like I put a certain amount of money aside that I'm okay willing to lose for like entertainment purposes. Like, okay, here's $100. I'm okay throwing this on a game and losing it. I would never do it. And like, I've been at the casino and stuff playing blackjack next to someone who you can tell is like losing money that they need. Like they're like betting with rent money and losing it. And it looks so painful and like a spot that I never want to be in. So I essentially just like compartmentalize it and say like, okay, this money I'm okay with losing for entertainment purposes. This money I'm not. Like I will not touch this is what I need for like whatever. So it's like, look, is it a great habit? No, of course not. But I do get more entertainment and more fun out of like throwing $50 on a game than if I were to just watch it without it. So like I understand myself, and I know it is really sad, and that's what's kind of like turned me away from like gambling. Like I don't even really like going to the casino because I think going to the casino is kind of just sad in general. Like you look around at like you'll see a row of slots and it'll just be full of like, no offense, older people just hitting the button over and over and over. It feels so dystopian. But I like I said, like I know myself, and I know and that's not to say that I've never like gone overboard or bet too much or that I never will, because again, like it happens to a lot of people. It happens to a lot of smart people that they start gambling too much. I just, where I'm at right now, I've like figured out, okay, here's what I can do. Here's what I can't do. And so, yeah, so I appreciate the thoughts looking out, but I'm buying DraftKings tonight because again, like it's just crazy. You go anywhere now, especially here in Michigan. Like I just hear people all talking. Like you go to a Pistons game or whatever. Everyone has their phone out checking their bets. Like I just think it's a lot more than people are doing it. Yeah, I like playing some poker too. But all right, y'all, let's go ahead and wrap up for the show today. We'll be back. I'll be back on pre-market prep tomorrow morning. Till then, stay green, y'all.